So in this segment, we're very privileged to have Joe Brusuelas, Chief Economist from RSM, here on campus with us today to talk about RSM's view of what's happening today in this sort of very dynamic environment. Things will have changed by the time you watch this video, but right now the stock market is down again dramatically, and it looks a little bit like we're on the precipice. So one of the things I wanted to talk about is government policy. The Democrats in the House of Representatives are putting together a stimulus package. Not sure whether the Republicans in the Senate are doing the same. They had a conversation with the president. The Federal Reserve is looking at lowering interest rates. Let's start by talking about the Federal Reserve. I know that you are in contact with many people on Wall Street and with your clients and so on. The Federal Reserve has a very low interest rate. They can lower it to zero, but many people are saying that they have no bullets left. All they can do is sort of, point the policy gun and say, bang, bang, please listen and invest. What is your view about monetary policy, and can it really have an effect on what seems to be a downward spiral that we're seeing in financial markets and maybe the rest of the economy?
I think that monetary policy is not well positioned to deal with the sort of supply shocks that are cascading through the real economy at this point. I think that the Fed's in a terrible position right now. You see yields across the front end of the curve below 1%, depending on what day, what hour, what minute, it's below 0.5%. Mm-hmm. That would imply the Fed's going to take the policy rate to zero. At this point, I think what we need to begin thinking about is what other measures can the Fed take to stabilize financial markets and even on the margin help certain areas of the real economy until the fiscal authority gets its act together and really begins to direct policy at ring-fencing portions of the real economy so that we don't have a larger drawdown in overall economic activity than we need to. My sense is that the Federal Reserve is thinking about restarting asset purchases. I think that they're thinking about perhaps, if necessary, coming back with another term, asset-backed securities facility, our lending facility, what was called TALF, during 2009 to 2010 when that facility was up and running. As we talk to our clients, as we look at the economy, this is a very different crisis than we went through 12 years ago. The combination of supply and demand shocks and financial shocks that are going to, again, cascade through the economy, demand a response, primarily fiscal, but if necessary, monetary, that targets the small and medium-sized enterprises in the real economy. Those are the firms and the workers, the personnel who work for the firms, that if there's a period of, say, 6 to 8 weeks where we don't see a lot of economic activity, they're going to be hurt through no fault of their own. So we get the sense, and you saw Chairman Powell when he spoke the day the Fed engaged in the surprise 50 basis point rate cut, say, we can't fix supply chains. Monetary policy isn't what we need. We need fiscal policy, all right?
Yeah, but in that regard, suppose the Fed does TALF 2.0. Yeah. Doesn't that send a signal to the market, to Main Street, that, well, this is like 2008. No, let's not engage in investment and let's trim our labor force and costs before we get really over the barrel on this?
Well, that's the cost of being the adult in the room when a crisis happens, isn't it? Is you have to make choices. There are going to be implicit winners and losers who are going to be chosen under that. I think that what we're seeing as we sit here, you're seeing stress in credit markets increase. I see dollar funding stress. That would imply the Fed opening up swap lines. I don't want to be the person who has to go tell the president that we're going to open up swap lines to help Japanese and the Europeans. There's a lot the Fed can do, right? And I think that if the delay in fiscal policy, which is looking increasingly likely, happens, I'm not sure how much longer they'll be comfortable waiting, even if it's just an 8 to 12 week shock, simply because the aftermath could be very difficult to stomach with respect to bankruptcies along Main Street and the unemployment that would follow.
But in that regard, in fiscal policy,
Yeah.
by the time it gets passed, and let's suppose it is what the president was proposing, a payroll tax cut, by the time it gets passed and it gets into the hands of those who are working, we're pretty far down the line.
Yeah, that's the problem with the payroll tax holiday idea. What we need to do is direct transfers of cash into households. Whatever you want to call that, whether I'll call it fiscal aggressiveness, helicopter money, whatever you want to call that, that's the way to deal, I think, with this very unique outlier of risks that's going to cause different shocks than what we normally see. I mean, let's face it, there's no playbook here.
Yeah, so we as economists can agree that making those helicopter drops
Yep,
to the individuals whose marginal propensity to consume is close to 1,
That's right.
meaning the low-income individuals, is how you stimulate demand.
That's-
But in this environment are we talking about things that are academic?
No, I think what we're doing is we're providing a service here by talking about policy creativity across the discipline and through into the real world here, right? I mean, they're having these discussions at the Treasury and at the Fed right now. The White House, well, they're divided on what they want to do because let's be honest, this doesn't fit their ideological framework, right?
Yes, I mean, that
Yeah.
was the nature of
Yeah,
my
no,
question, right?
they just doesn't. And you're right. The 3 lower quintile of income earners, they have a higher marginal propensity to consume than the upper 2 quintiles. And that's who the first tranche of policy needs to be directed at. One of the issues with the payroll tax holiday is it really benefits the upper 2 quintile of income earners. Now, there's going to be a case made by the White House, and you can just see it coming, that, well, the financial shock is going to impact them and we need them to spend, right? But to be honest, the GOP Senate just simply right now is not interested in another payroll tax holiday. So we're sort of stuck at this point. Now, I do think there's a lot here on the table that we do need to talk about. Elasticity in terms of how we're going to interpret unemployment and unemployment insurance. If we need to take it to 99 weeks, we need to take it to 99 weeks. We need to waive every copay for any coronavirus test. We need to make sure Medicare and Medicaid are fully mobilized. We need to mobilize the entire set of agencies and all offices that direct aid towards trade finance. Remember, during the last crisis, what was one of the first things financially to collapse? It was trade finance.
Correct.
Right?
Yeah.
If that means a
Very
tariff
dramatically.
Yeah, right. If it means a tariff holiday, it means a tariff holiday. One of the things about we economists is we have good institutional memory. We have an idea of what to do, and I think we know how to do it, and it's time we get to it.
And the real question is the willpower in Washington to do it. But let's move to Main Street. So Ed talked about how recessions, at least sort of the last 11, had a lot to do with durable goods manufacturing imploding or shrinking or contracting, however you want to put it. The auto industry has been held up by subprime auto loans. In today's financial market, I would imagine that those are going away. So this is a big industry in the US, major employer in the Midwest and Mid-South. What is your take on what's going to happen with the auto industry over the next 6 months?
A couple of things. First is there's going to be very shortly a shortage of supplies. The parts simply aren't showing up. You know, we've been talking for a number of weeks. Both of us have talked about what's going on at the trade, at the ports. Right? I flew into Seattle 4 weeks ago. One ship in port, one waiting. I asked the locals and they said, nope, this has been going on now since late January. So that's now showing up. Second, it's hard not to see, given the prevailing financial conditions, that lending's not going to slow. I don't want to use the word freeze because that's got a bad connotation from the financial crisis, but we're going to see a slowing of large capital purchases, autos, and I would think housing. And because roughly, I think 23% of all auto purchases during this business cycle have been of the subprime variety.
Right.
Yeah, you're going to see those profound second order shocks as we move from supply to demand shock.
And then potential home buyers saying, the prices look right, the interest rates look right, but I don't know if I'm going to have a job.
That's right. So people are going to be naturally risk averse. And even bank credit quality personnel are going to say, maybe we ought not to be doing this. One of the interesting things over the last couple of weeks is watching what's going on in the lending complex, right? You can see 30-year mortgages not adjusting down properly to what you're seeing at the long end of the curve. And even last week, we saw the rates creep up, which caught my eye to think, okay, perhaps we're already at that point where the risk aversion among in the loanable funds market has arrived, and we will see the follow-on here in the next month or two in the data.
Yeah, and you spoke about trade. So agriculture is quite important here in California, but agricultural products, even though they have buyers in China, can't get to China because the containers that carry them are stuck in China at the ports, and the Chinese ports are clogged now. So farmers have had a tough year.
Right.
And we're not so inclined to buy farm machinery. What happens now?
Well, you're going to see a backup in the volume of trade. One of the things when I was in Washington a month ago was our clients told me exactly that. We have a lot of tech and we have a lot of ag. We want to ship to Asia, but there's simply not enough containers to do so. Before the whole COVID-19 crisis erupted, we had already spent more on the bailout of the farmers due to the trade war than we had the auto bailout. We're going to have a very interesting discussion about bailouts and who gets bailed out and who doesn't, right? My sense is, given the unique configuration of power in Washington and the long-standing power of the ag community, that we're going to have another round of bailouts for the farmers. Now, this morning before I came over here to talk with you, you could read the papers, and they were talking about a bailout of the shale and fracking communities, which struck me as a little tone deaf. But that's an indication of the type of conversation that we're going to be having over the next couple months in terms of policy out of Washington, D.C., and just where does the White House and the fiscal authority want to go with this. Because, you started it off asking about monetary policy, which I think is the proper place. What we need is a good old-fashioned Keynesian coordinated fiscal and monetary response to this, to deal with the likely large sudden adverse shock that we're going to see. And we'll begin to see it here in the jobless claims data, I would think, over the next week or two.
Right, and so far the initial claims for unemployment have not moved very much.
No.
And when you adjust those for the size of the workforce, which is a layoff rate basically,
right,
it's at historically low levels. So that needs to spike dramatically if it's going to indicate a recession, right? Right,
and to bring it back home here for the California portion of the Anderson School forecast, which is absolutely fantastic. We love it. You and I are both talking to people at the ports in Long Beach and Los Angeles. We had a bad February. I think if you sort of net it out between LA and Long Beach, it's over 20%. That's right. That's good enough to just think 1/5, right? I have long-standing friends from being a child here in Southern California who work at the ports. And they've been telling me for the past month they've laid off all their best longshoremen, and now they're at a shortage of workforce. It'll take a couple weeks, if not a month, for that to filter through, but we'll start seeing it in the data. And it's too bad we can't look at the weekly jobs claims in real times by industrial ecosystem. That would be truly a thing, I think, that would be useful in terms of the reaction function of both the monetary and the fiscal authority.
Yeah, they tend to be reactive because they have to look at data first,
right,
and the data is about the past.
That's right.
And comes with a lag.
Yeah, well, one of the things about being a business economist, as opposed to being an academic economist, is we get out of the country and we get to talk to our clients and we get to hear them. So I can be a little bit more bold in terms of talking about anecdotes against, time series, but eventually the anecdotes or the time series catch up with the anecdotes, and then we know, we need to act, and we need to act now. I think it's the most important thing when we're talking about this particular episode. Time is of the essence. My sense is it's better to move fast, to move boldly, overwhelm the problem, and be willing to sustain it for a long period than what you're probably telling your constituencies.
So what's the good news? What is the good news you're telling your clients?
Well, when we talk about good news, obviously, depending on what industrial ecosystem you're in, you're going to have varied news. If you're in private equity and you've got a lot of cash built up, this is another one of those once-in-a-lifetime opportunities. A lot of small and medium-sized enterprises who've got good lines of business, or going to be in a position where if there's a disruption in revenues, they're going to need to find a partner or they're going to look to sell, right? Depending on how lending evolves under the current conditions, you need to refinance, it's a great time. You're a first-time home buyer and you're secure in your job, let's say you work in tech, take advantage of the opportunity, right? If you own a home, that's a fixer-upper. Rates are going to be low. There's going to be an America's going out of business sale in some portions of the economy with respect to furniture and getting labor, which will be plentiful real quick. It's a good time to move. It really depends which sector or which subsector you're talking to with respect to what the news is going to be.
So this growth in the non-bank financial sector, which has happened over the last decade, in part in response to Dodd-Frank, that has the opportunity to step in as financial markets are distressed and really pick up the slack, is I think what you're saying.
Yeah, one of our best business development guys told me that exactly thing. Almost the exact words yesterday, is that the non-bank financial sector. It's great, and great minds think alike sometimes. And it's going to cause a further change in the structure of that portion of the economy. I think one of the interesting things, and Eric Brynjolfsson at MIT made this point last week over social media, which really I think got some attention, is we're about to engage in a great experiment. Any task that can be done remotely for whatever reason inside our workforce is going to be explored here over the next 2 to 3 months. And I've been through enough business cycles now as a professional economist to know that whether we have a recession or not here, the American commercial community is going to take this as a tremendous learning opportunity. And if they learn that certain tasks can be done just as well remotely, it's hard to believe that you're not going to see a shift in the relationship between work, home, and technology. I think that some work will not go back to the office.
So this is, the transformation of the U.S. economy from an industrial economy to an information economy. What you're saying is this is going to accelerate that transformation.
That's right, and of course, what that implies is pulling forward the time of automation, robotics, artificial intelligence, and machine learning, right?
Right, which relates a lot to Ed Lemer's presentation on minimum wage, that what happens with those lower wage workers who are engaged in some repetitive work, although hard to flip hamburgers from home.
Right. Well, there's some portions of the economy, such as leisure and hospitality. I think about 1 in 9 jobs, leisure hospitality. Now, that can be done from home, so we may see some disruptions in patterns of employment. But if you travel like I do, we were at a Lowe's Hotel in Chicago 3 or 4 months ago. They have something called the Lobot. The robot will bring you things. And I thought, well, this is interesting. I haven't quite seen substitution like that before. But it's there, so firms will get quite imaginative in response to this very unique crisis.
So what that suggests is that there's a real opportunity for the tech business on the West Coast to be the industry that, as in the last decade, has led the expansion as we go forward from 2020. So that's good news for California.
Yeah, so 2 things is, one, the substitution of technology for labor is clearly going to pick up. That's a clear lead advantage of tech everywhere in California. Second, COVID-19 is not going to infect 5G, right? You always got to look for the silver lining. And if you're a Californian and you work in tech, those opportunities are all going to be brought forward very quickly. And I could see a fiscal response that is partly dependent upon infrastructure. And my sense is that's going to be a big part of any infrastructure response to the crisis.
So we've talked a lot about the uncertainty today.
Yeah.
And we are in a very uncertain environment. In our forecast presentation for California and for the US, we kept referring to could be a recession, it's getting close. What would you suggest are the things that people ought to be looking at to ascertain whether or not we're going to have like a 1995 slowdown and then kind of skip right through it, or this is going to be an economy that turns negative in the middle of 2020?
Well, I think that this is where economists really want to slow down and speak to the public, not to each other. We made some mistakes during the last crisis. I think that we need to methodically explain to the public what's happening and bring it back down to jobs, because that's where the public lives. Mm-hmm. You know, whether it's a population adjusted estimate of weekly initial jobless claims, or just simply presenting the 4-week or 13-week moving average and saying, if it moves above this point, say 243,000, there's going to be a problem. So you convey to them with a forward look that, yeah, you're going to need to change your behavior for a certain period of time. You know, normally when we have these episodes, the NBER dating community, which does a great job, right? I'm not going to put them down at all. They'll call the recession about 6 months after it started. Yeah, I have a feeling this is going to be a little different this time. That we've got some very good models. You know, Menzies Chin at University of Wisconsin now puts up, you know, Hamilton filtered recession probabilities on social media. And that didn't happen when we were doing this 12 years ago.
Right.
Right. We were all in the dark together. And the fact that he's doing this on a monthly basis, not a quarterly, he's not waiting. He's going out there and putting that up. A very sophisticated filter, James Hamilton at the University of California, San Diego. It's providing an invaluable service to the commercial community. And I can take that because I understand what it is, how it's put together, but I don't have to explain the econometrics and the science of it. I can go to a CEO or a CFO and say, hey, take a look at this. This is a possibility of where we're going to go unless A, the medical community can solve this problem quickly, or B, there's just a general reassessment of risk and things turn around, right? And I think that we got a real opportunity here within the dismal science to provide a true public service. And I think the UCLA Anderson's School of Management's forecast is at the forefront of doing this. Thank God we have the University of California on the front lines medically. Mm-hmm. And I think in terms of the forecast and the public advisory service to both the public sector and the private sector.
Yeah, and that's why we keep trying to, taking your advice, go for higher frequency data such as our monthly GDP, which is higher frequency even than the national GDP. And of course, California is 12.5% of the U.S., so
yeah,
it matters a lot.
My model through the end of February without the net exports is 1.4%, but with significant downside risk once we get the March data.
So this was a mixture of uplifting and realism. And I guess we should be looking to Washington and see what's going to happen in a policy response.
Yeah, I think so.
And if we have gridlock, that's certainly one message for the way in which this is going to evolve over the next 6 months.
Yeah, you know, when we're in Los Angeles and we like the entertainment sector here, we like movies. There was a great movie on when I was a kid. My parents had it on the background. Martin Scorsese directed. It was called The Last Waltz, right? Mm-hmm. We're about to see a string of data that shows where the economy was at prior to the shock.
Right.
And it's going to be the last waltz for the business cycle. Mm-hmm. And then we'll have to see how it evolves. My reaction function would be to act now, act preventatively. While I don't think the Fed's well positioned to deal with this, I'm glad they did a 50 basis point rate cut. And they're going to take the policy rate to 0. And then we'll see what they have to do based on what the fiscal authority, what Congress, and what the administration can work out. Right now, it looks as if they're going to leave Friday for recess without having done anything. We'll see how the public thinks about that in 2 to 4 weeks.
Yes. Joe, thank you very much for joining us today here at UCLA. And as always, your insights are really valuable. So
Thank you.
many
I
thanks.
really enjoyed this.